share buybacks. They weren't always legal, but once companies were green lighted by Congress, how did that change the dynamic? And how did dividends play into that? A year ago, we were talking about record levels of share buybacks. Obviously, that's dissipated to some extent, but if I follow your data correctly, there are still some big companies out there that are still doing buybacks. So how have buybacks evolved? How have they influenced dividends? And what can we expect going forward?
Buybacks did start to come more into fad when the regulations were changed for several reasons. Companies saw them as a cheap way to protect their earnings. Especially technology, they used options a lot. So they would give you an option to buy the stock, say at $30. The stock was now, years later, $50. If you exercise that option, my EPS go up and go down because my shares go up. So they'd go into the market, they would buy it for $50. You give me the 30, it only cost me 20. Then very quickly after that, companies figured out they can adjust their earnings, okay? And this is why earnings per share and methodology and buyback need to be an undergraduate course, not a graduate course. Companies can go in and buy discretionary. In that case, it's usually controlled more by the board of directors than the actual day-to-day people because it's so much more expensive. I go in and I buy that full share at $50. Okay, and I put this share in my treasury. I don't retire it because I can always use it later. In some European countries, you have to use it or lose it, but they put it in the treasury. And my share count now goes down. Okay, and at this point, that means my EPS go up. Well, EPS go up, that means my PE is less. I'm a bargain, like me before. Now instead of having 18 PE, I have 17.6. And we've seen significant buying and adjusting because at one point in 2004 and 2005, I and other companies, we put out messages to our analysts, when you're doing your estimates, make sure you have the correct shares because buybacks, we do so many of them. What would happen is the analysts used the wrong shares and therefore they had a lower EPS. They might have had the right net, but they had the wrong EPS. So when that number came across the wire at 4 o'clock, I got a beat. What am I doing? I'm buying. Okay. And then the CFO and the numbers come out. It's not a beat. It's the share count adjusting. So literally, it was a major problem on there. SEC got involved with a whole bunch of stuff, but buybacks became very popular. At one point, a quarter of the companies bought back enough to significantly change their EPS. We believe that 4% is a significant amount because, again, year over year, you're comparing my PE. That means my PE has changed 4%. My EPS has changed 4%. We did some statistical testing. It came out to like 3.7 something. Good enough, make it 4%. And so we measure that. And that has gone up an average over 20% of the companies. So 1 in 5 companies you could typically pick out that have earnings that are a minimum of 4% higher because of the EPS. So this is impacted. And remember, those trades are actual physical trades. It's not option trades negating. It's going to the floor or the system, putting in the trade. So you now have more buyers. My stock is worth more with 5 buyers than 4. Doesn't change my stock. So buybacks became an enormous item. It's what in the 70s and the 80s stock splits were. You announce a big buyback, your stock goes up. You've got support. It supports my stock. It adds to my EPS. It is a win-win situation. What's happened now is that because liquidity still remains the main issue, companies that can buy back have high cash flow, not just earnings, but cash flow, Apple's, Microsoft's, okay, they are continuing. And for that reason, in our last full quarter, 83% of the top 20 companies accounted for 83% of all the buybacks. You either did them or didn't. Other companies did not. Financials dropped over 90%, even after Warren went in and bought $5 billion in buybacks. Financial went down because the Fed, as you recall, came in, made comments, shock and dismay. Within 24 hours, the banks came out and said, I will not buy them for second quarter. I will not buy them for third quarter. Now they're not buying them for fourth quarter. So buybacks, as you say, went totally down from the plus 200 to 88 billion last quarter. This quarter, I'm looking for about 100, 101 billion. There is a potential, small, very small, for a buyback bonanza. If for some reason the market perceived that buybacks would be taxed significantly different next year. Go back a couple of weeks to when a pure Biden win was in there, and with including potentially the Senate, the House, and the White House. And the concern was that buybacks next year would be taxed differently. Companies couldn't do it. So it might have ended up, and it doesn't seem the scenario now, but the item was that use it or lose it. Go get them now, because you do them next year, it's going to cost you. The same with dividends. I mean, when tax rates went down, okay, companies did not pay, a lot of them did not pay Q4 dividends. They paid them at the beginning of January because you as a holder was getting more. Well, dividend tax is expected to totally change next year. Picture's not clear, but if you go through the agendas there, it's going to increase. So the question companies had to at least address internally, I've got a dividend that's going to be paid out, in January. Do I want to do it in December? A lot of the retailers use January, of course, on there. So do you want to pull it back? Those do not seem what's happening, but dividend, obviously, and buybacks are connected. Companies have so much to spend. COVID, of course, totally changed buybacks and dividends. Companies' cash flow was cut off, like a light going out. If you were a hotel or something, or a convention center or travel, you got no cash flow and you had enormous expenses. Companies had to prioritize their self. Okay, buybacks were the last thing. Typically, up to that point, you want to increase buybacks, you go to the board and they make a decision, do I want to do it or not? I have plenty of money. They could do whatever they want. Now, money, liquidity was the main issue. Because of that, buybacks took a far back seat. Okay, and we see that in the numbers. Dividends were a different situation. Companies didn't want to reduce their dividends, poor signaling. Those that had to, again, going back to the hotels, going back to those that had their cash flow done, we saw an enormous increase in suspensions, not cuts, but totally shut off. 42 companies in the S&P 500 alone suspended their dividends, not cut, but suspended them, because it was an immediate turn-off of cash flow. At this point, we're seeing dividends still continue. We are going to see a good year in dividends this year, considering everything. Q1 for dividends was a record. Okay, second quarter, since so many were already declared, came in very good. Q3 went all the way down in Q4. Bottom line for the year, actual money in your pocket on S&P 500 dividends, 1% down. Given everything, that's a good number for actual dividends. But what we're seeing in dividends is fewer companies are increasing them, and this is within the 500 as well as the U.S. common domestic market. Fewer are increasing, and the average increase, okay, for most companies, average increase is significantly been reduced to the 4% area from the 8 and 10% number. Those that have good cash flow and still have the money are increasing high. We saw the Microsoft $1.5 billion more on there. So there are companies, again, that have cash flow that are doing buybacks and are doing dividends, but that's the minority in there. Mm-hmm. All dividends are holding their own. Okay, 1% down is not a bad number at all. It's not the 9.5% we were thinking of at the beginning of the year, and a lot of analysts made that 10%. Of course, you return to a nice double-digit number. But 1%, considering where we stand and where we looked at things in March, is very good. So dividends, definitely a positive item, especially with interest rates so low now, whether it be banks, bonds, sure. Certificates, whatever. There's nowhere to go. If you're looking for yield, you have money sitting on the side, you're not getting anything. You have to be there because you do not want to be an alternative. You don't want to be in the market. You don't want to be wherever it is. But you are not making money on the side. So yields are one of the few places to go. Within the 500, yields are about 1.7% in the index. But for those issues paying, it's 2.2%, which is still a very good yield. However, of course, there's risk. There's always risk in any investment. And it does you no good to get a good yield and have your stock tank.